Well, hello and welcome to today's webinar from the Center for Ag Profitability at the University of Nebraska-Lincoln. I'm Brad Lubin. I'm an Extension Ag Policy Specialist, and I invite you to find a variety of information on our farm and ranch management tools and resources on our center's website at cap.unl.edu. This is the latest in our weekly webinar series with the Center for Ag Profitability, and it focuses on biomass-based diesel and soybeans. In recent years, expanding production of biodiesel and renewable diesel has increased demand for soybean oil and created new connections between energy policy, fuel markets, and farm level economics. As renewable diesel capacity has grown, policy incentives and low carbon fuel standards have played an important role in shaping demand and influencing soybean markets. Today's webinar will look at how biodiesel and renewable diesel are produced, how the markets function, and how the policies influence industry growth. We'll also discuss how those policy market developments translate back to soybean demand and farm economics. We invite any questions that you have to type them in as we go along. Type them into the chat box or the Q&A panel in your Zoom window, and I'll moderate those and bring them up for questions and answers at the end of our presentation. We're pleased today to have a guest and a very good friend of mine, Dr. Scott Gerlt, Chief Economist for the American Soybean Association, headquartered in St. Louis. In his role as Chief Economist, Scott leads the market and policy analysis to guide the organization's strategic decisions and frequently presents and writes about issues affecting the soybean industry. Information that you can find on the American Soybean Association's website, as well as often contributions often to their press activity and press information. So, Scott, welcome. I should say before you joined American Soybean Association, I've known you for a few years and had the privilege of having you help us with our North Central Extension Risk Management Education Center work as well. But prior to your role at the American Soybean Association that you joined in 2020, you were a program leader for crop policy and analysis at the Food and Ag Policy Research Institute at the University of Missouri as well, which is where you hold your PhD from. So welcome, Scott. Thanks for joining us today. We look forward to your discussion about biomass-based diesel in the soybean market.
Yeah, thanks for having me, Brad. I'm really thrilled to be here. Always enjoyed my interactions with Brad and have thought a lot of those over the years. So whenever Brad asked me to speak today, I was more than happy to do it. So I like that Brad mentioned I used to work at FAPRI at the University of Missouri, and my role there was really working on farm bill, crop insurance, things like that. And so whenever I joined ASA in 2020, and I was the only economist on staff, first one they had in a long time. And I thought, well, I might have to touch biofuels a little bit. I mean, I knew some about biofuels, but I always tried to avoid them. To me, it's like working on sugar or dairy policy, just very niche and complicated and with a lot of politics. Um, and so I thought, well, that might be a small part of my role, but I probably won't have to spend too much time there. In the 5 going on 6 years, I've spent most of my time, by far most of my time, on biofuels policy and markets. It's really been the driver of demand growth for the soy sector. So with that, let's jump in a little bit. It's there's not a lot that's all that simple whenever it comes to the sector. I'll really try to keep things at a level to keep it from getting too complicated. But this really gets just by its nature a little bit in the weeds. But let's start with the broad view. Let's look at U.S. soybean demand in general. How are we using soybeans? Historically, we saw the growth in demand really through exports. You can see there in the early 2000s, just that large upward trend in exports. And domestic demand was kind of kicking along, but it didn't have that rapid growth that we saw in exports. And then, around 2016, 2017, we saw actually exports overtake domestic demand. But then we had the first trade war, and we dropped our export levels back down. After that trade war was over, China came back and bought a lot of beans, but that didn't continue. They've been continually buying less and less from the United States. So we've been continually exporting less through time. But you can see the really kind of change there on the domestic disappearance side, that rapid kick upwards in that curve. And that's really biofuels, just because of the rise of renewable diesel, the increase in domestic crush capacity that we'll talk about. So we've really kind of shifted the trajectory of where we're using soybeans. It really the demand area or the demand growth area right now is on the domestic side, largely for biofuels. Um, and so that's why I've had to spend so much time on this. So let's start with a little bit of background, so that we all understand what we're talking about. So whenever I say about biomass-based diesel, there's really three things I'm referring to. One is biodiesel, which probably everyone has heard of. It's been commercially available for a long time, and it uses a very specific process, transesterification. And so you take a fat or an oil, put it with a small amount of alcohol, and you get a diesel-like fuel and glycerin. Typically, biodiesel is only blended up to 20% levels in diesel fuel. You can go beyond that. It is possible. But just for a lot of reasons, that's typically kind of the max blend level in a lot of places. The newer kid on the block, as far as really commercial availability, is renewable diesel. And this is the one that's driving the growth. So it uses a different production process. So it can also take a fat or oil, but it uses hydro treating to create the renewable diesel, and it also has a few other co-products as well, like naphtha. And really the way that's produced creates a different product. So renewable diesel meets the same ASTM standards as petroleum-based diesel. And what that means is it's a pure drop-in fuel. You can put it 100% in your tank without any considerations. You can run it through the same fuel supply. It does not have to be labeled differently than petroleum-based diesel. And frankly, that's why it's doing so well, is it can be put in through traditional equipment. Um, so hydro treating, for those that aren't petroleum engineers, which also includes me, is done at a petroleum refining facility. And so what we're seeing in the space is a lot of petroleum refineries being converted to renewable diesel plants. It's very expensive to decommission a refinery in the United States. There's a lot of red tape. And so instead, for some of these refineries that maybe don't make sense for petroleum anymore, th those companies are converting them to renewable diesel production. It takes some extra investment, but then they can produce renewable fuels that they can use for some of their renewable fuel standard requirements. And so you see a lot of the big players in the petroleum space whenever we talk about renewable diesel. So like your Phillips 66, your Valeros, your Marathons, your BPs, names that traditionally are not in the biofuel space. And it's also, this shift has also realigned the politics of biofuels as well. Instead of being against biofuels as these companies saw them taking their demand, they're now producers of biofuel and actually joining with ag on some of these things. The last one, which we're really not going to spend time on today, is sustainable aviation fuel. It's a similar process to producing renewable diesel, or at least for fats and oils, but it takes more processing. It's very expensive to do, and it's just not really financially viable at this point with the incentives we have in place. So let's talk a little bit about biomass-based diesel economics, and this is really key to understanding everything we're going to go through. So biomass-based diesel generally costs more to produce than petroleum diesel. Just the feedstock cost alone. So I say feedstock, I mean like your soybean oil or your used cooking oil or your canola oil. So your fats and oils. That the cost for those, if you just converted that straight into per gallon, is going to be more than what petroleum sells for. But being an economist, a lot of it comes back to externality. So benefits are or conversely negatives that are unpriced by the markets. And so these biomass-based diesel have greenhouse gas and emission benefits that are not priced by the markets. Or conversely, you could say petroleum has a lot of negative benefits when it comes to greenhouse gas emissions that are unpriced by the markets. And so really the policies help cover that, and help make biomass-based diesel viable in the marketplace. So really, it does that through credit, through policy incentives to make up that difference between the cost of producing biomass-based diesel and petroleum. So there's three programs. that we talk about. And whenever you add these programs together and the crediting from them, we call that the credit stack. So the first and the most important is the Renewable Fuel Standard, the RFS. It sets the blending levels, and we'll talk about those. So the RFS determines the size of the overall consumption in the United States, and that's really important. If you took away the RFS by itself, these other policies really wouldn't by themselves produce a lot of biomass-based diesel. It's really the RFS that's the driver. The next one is the federal tax policy. So historically, that was the blender's tax credit, the BTC. That has now changed to 45Z. And the last one is state programs, particularly in California with their low carbon fuel standard. And so to really kind of show how much the industry has changed in the past few years, biodiesel capacity has really been fairly flat for a while. You know, that 2 to 3 million gallons per year of annual capacity. Back in 2021, we only had about 1 billion gallons a year of renewable diesel capacity. But we've shot up to about 5 billion gallons of renewable diesel capacity in that 4 to 5 year time frame there. So we went from, 3,000, 3,500 billion gallons a year, million gallons per year, to over 7 billion gallons per year. So we've pretty much doubled our capacity in a few years' time. And so whenever that started to happen, it was really assumed that soybean oil would be the feedstock of choice. Um, there are other things that can be used. I've mentioned a few. One is used cooking oil, which is what's left over from a fryer. No one's frying food for the used cooking oil to put it in biofuel. So that was assumed to be very inelastic in supply. So you just really couldn't scale it. You can use tallow. Again, tallow, like the inedible tallow, is largely a byproduct from animal slaughter. Pretty low value. No one's going to increase slaughtering just to get that inedible tallow. There's canola oil, which can be scaled a little bit, but it's a lot smaller scale compared to soybeans. There's things like corn oil that comes from ethanol facilities, but again, small part of the value, so largely considered a byproduct. So it was really seen that soybean oil would be the feedstock of choice because we produce a lot of soybeans, and so we can scale that. Now, as you all probably know, being an ag audience, no farmer produces soybean oil directly. They produce soybeans, which is really two product, the meal and the oil, and you don't get the oil unless you can crush the bean. And so we needed more crush capacity in the United States. And we saw the large companies responding to, kind of the AGPs, the ADMs, the Cargills, the Louis Dreyfus, and others. And so if you kind of go back to the start of the renewable diesel boom, we had about 60 domestic crushing plants. There were announcements put out that would be for 20 new or expanding plants during the time that would increase capacity by about 30%, which is a very, very large jump. Generally, this is a fairly stable industry. And so there was a lot of excitement about all this new increased crushing capacity domestically and what that would do. And we do know it increases basis. We had a study done actually by Purdue in Illinois that looked at the basis impacts of crush plants. And they found, depending on how far the farmer was from it, the basis impact could be 10 cents a bushel to up to a quarter. So there was a lot of excitement just about that. And if we kind of put this on a time frame, we still have more domestic capacity coming online. So if you look at the crop we're getting ready to plant on 2026, 2027 marketing year, you can see we have over 1 million bushels of capacity, new capacity coming online this year, and still some more in the year after that. And then we start to flatten out. We haven't seen as many new announcements or actually any new announcements for just a bit here. Some of the RFS policy and some other things have caused some uncertainty, which put a halt on that. There is the potential for this to keep growing, but I think we're going to have to get a little more policy stability to get there. But the plants that are already being built and are far along or expanded, those are and will be coming online. Okay, and so we can't talk about biofuels without talking a little bit about how the RFS works. This goes back to 2007, the structure. So it's been around for a while, but I have the fortunate ability to talk with a lot of people in the biofuel industry, And there's even a lot of people in that, especially on some of the ethanol side, that don't fully understand this. So the RFS allows EPA to determine how much biofuel is blended with the petroleum fuel supply. And there's several categories that fall in there. The overall is the conventional. So any biofuel that has at least 20% reduction in GHG emissions or greenhouse gas emissions can qualify for this. Um, so a fun fact, there is actually no ethanol mandate in this country. Um, Ethanol can qualify for this. It meets the criteria. But this category is for everything. But corn-based ethanol can only be in the conventional category. It cannot fit any other category. So you could use ethanol to fill all the obligations in this category, but you don't have to. Um, Within that, there's the advanced category. And so you have to have a 50% GHG emission reduction. So you go from 20% to 50%. Now, if you produce an advanced fuel, it can be used to meet the advanced biofuel obligations, or it can be used on the conventional. So you can use it for the broader requirements as well. And then within advanced, there's two others. One is cellulosic, which is pretty small, not really worth talking about. But the other is biomass-based diesel. So everything we've been talking about fits in this category. They all have a D code, D4, D5, D6. And so oftentimes, for shorthand, we'll just say D4. So you have to have a 50% reduction in GHG emissions here as well as be a diesel on-road diesel substitute. And so if you produce that D4 biomass-based diesel, you can use it for the obligations for the D4 category, the advanced, the D5, or the conventional D6. So it gives you a lot of flexibility. And so that kind of gets us to how the blending levels are set. So there's a lot of acronyms. This one's the Renewable Volume Obligations, and EPA sets these now. They set the minimum blending level in the domestic fuel supply. So for each of those categories, EPA will say you have to blend at this percentage in the fuel supply. Overall, I think we're around 15% once you go to the conventional. Um, Now, for biomass-based diesel in particular, since it costs more than petroleum to produce, the RVOs are both a floor and a ceiling. So they're the minimum amount you have to blend, but because it costs more, you're not going to go over that. So really, it does set the blending level. Um, and so it also sets, as it's just saying, the amount of domestic consumption. And that's an important point. Sometimes people talk about these other programs. We'll talk about 45Z state policies. Those don't set the overall blending levels. They have some other effects, but not the overall blending levels. And one thing I'll point out is the RFS is feedstock neutral. So it does not care whether you use soybean oil, corn oil, UCO, or any of those things to make your D4. Those all qualify, and they all uh, work towards the same blending levels. And so the compliance for those RVOs are done through something called RINs, or Renewable Identification Numbers. So when a biofuel is produced, it gets a unique number. And that number is critically important in the program because a petroleum refinery has to meet their blending levels, and they do that by turning in RINs at the end of the year to the federal government. So they need to have a certain amount of RINs that they can turn in. And each gallon of biofuels produces a certain number of RINs. So ethanol is set to one. 1 gallon of ethanol equals one RIN. After that, it's based off your energy content, largely relative to ethanol. Biodiesel and renewable diesel have higher energy content. So biodiesel generates 1.5 RINs. Renewable diesel is generally 1.7. There's some nuance there. Um, and the interesting thing about this is those RINs are tradable. So, if I'm a refinery that blends, I have to turn in a certain amount. But if I consume more biofuels than I really need to turn in to show compliance, I can sell those extra RINs to someone that doesn't have enough. So these do have a market price. They do have a 2-year life though, so you can't keep them around forever. And you can only carry up to 20% to the next year. If you qualify or if you export your biofuel, you have to retire that RIN. You can't use it. And also that RIN is separated from the biofuel when it's blended with petroleum. So before that, that RIN is attached to the biofuel. And so if you ever look at biofuel pricing, you'll see things like B99, which is 99% biodiesel, or B100, which is 100% biodiesel. And they're priced very differently because the B100 still has that RIN that you can sell, so it has more value. The B99, since it has a splash of diesel in it, that RIN has been separated, and so you don't get that if you buy B99. And so EPA reports how many gallons are producing RINs, and you can really kind of see the renewable diesel boom here through time. You can see the start in 2022. We saw a lot more BBD producing RINs during that time, getting almost to 600 million gallons per month. Now, what you'll probably see there on the right is that large cliff, right? So 2025 happened. Um, and there's several things that are going on here. So I'll talk about this a little bit more, but EPA set the blending levels, the RVOs for 2023 to 2025, and they significantly underdid them. They have, and I feel confident saying that with not taking off EPA because EPA has even come out and said that themselves. The other thing that happened was the blender's tax credit of $1 per gallon ended at the beginning of 2025. We went to the new credit, which was less, and we didn't have rules for. So everyone was trying to produce as much as they could in 2024 so they could get that extra dollar per gallon. And then when 2025 hit, they largely shut off because they had produced what they needed to. So we saw that large drop. Now we have started to see some recovery. We've gotten more of the 45Z rules, but you can see 2026 has fallen off again. And I'll talk about this just a bit more, but basically we don't have blending rules for this year, even though we're in this year. So it's caused a lot more uncertainty. So I said, different feedstocks could be used. On the orange there in top is domestic soybean oil used in biofuels. And so you can see that growth in 2022, 2023, 2024. Then you see that crash there at the beginning of 2025. You can also see we've been importing more canola, predominantly from Canada. We do that for more than just biofuels. It's also for food. But 2023, canola was allowed to be used in renewable diesel, whereas before that could only be used in biodiesel. Used cooking oil and tallow have really been the big story. We've significantly increased imports of those. They receive very favorable crediting in some of the programs, so it was very profitable to use those. So we started pulling in a lot, and there's always been fraud concerns with used cooking oil because it's very hard to tell whether it truly is used in the fryer first or not, or how much it's used. And that may seem trivial, and for biofuel production, it largely is, but it determines the crediting amount. So there's this very strong incentive to call something used cooking oil, even if it may not be, if you're going to use it in biofuels. For instance, palm oil cannot be used for biofuels in this country for the most part. However, if you use palm oil to fry something, that resulting grease can be used in biofuels and gets a very good credit. So there's a lot of concerns about fraud. We saw EU start to crack down on some of this with China. So China started sending a lot of their used cooking oil to the US instead of the EU. And at the beginning of 2025, it got to the point we were importing almost as much used cooking oil for biofuels as the amount of domestic soybean oil we were using for biofuels. Now that has since retreated some. It's gotten into a better position, but it's been a very big problem for the industry that's caused a lot of division. But I don't want to say that it's been all bad for soybeans. It hasn't. So looking at the crush margins for soy, and I wish this chart went back just a bit further. We're having to change some of our data sources right now. But the crush margin is really the value of the soybean meal and oil minus the cost of the soybean. So it's essentially the margin a crusher makes. And if you go back historically, this would have been $1.50 most of the time. And I'm starting in the middle here of the renewable diesel boom. But you're seeing $4+ a bushel, depending where you are. Now it's fallen off a fair amount. We've gotten back to some more historical amounts, but we're running pretty strong right now. But it came down to that demand for soybean oil. It was running so hot for a while. And we are starting to see that pick back up some. We're seeing some pretty strong soybean oil prices again, as we're having some more favorable policy. And so kind of where do we stand on the RFS? That's kind of the background, but where are we at now? So the last one, as I mentioned, was in 2023, and it covered 2023 to 2025. I don't believe they released it to like June of 2023, so we're halfway through the year, before we knew what we were supposed to blend for the year, which is not how the program's supposed to work. So we need blending levels for 2026. EPA was by law in the RFS was supposed to release those finalized rules for blending in November of 2024. They released the proposal on June 13th, and we still haven't finalized. They still haven't finalized it yet. So they are a year and a half behind their legal mandate. I kind of wish I could turn in my taxes a year and a half late. I don't think that's going to go, but EPA is able to largely get away with that. But the proposal does cover calendar years 2026 and 2027. Now, I want to give EPA their due here. They've released a very, very favorable proposal for us. So going back to those D codes, the D4, the biomass-based diesel, that amount or that D code is the minimum that has to be blended into the fuel supply. Remember, we can also be using the advanced or the conventional. And you can see for 2025, that number was 3.35 billion gallons. For 2026, they're proposing 5.61. For 2027, 5.86. A massive increase. Now there's some uncertainty with this proposal, how like whether those numbers actually play out or whether in practice it could be lower, but it's still a very large increase, much larger than we've seen before. EPA kind of realized their mistake the last time around, and really want to try to fix that. Now you can see those other categories are largely held flat. There really hasn't been a lot of growth. Without E15 legislation, there's still kind of that 10 percentage point or so blend wall. So ethanol is I believe closer to 14 million gallons a year of domestic consumption. So there really hasn't been a lot of pressure to increase that. There were a few other changes in that RVO proposal as well. One of the most important ones was that imported finished fuels, biofuels, and domestic biofuels produced from imported feedstocks would only receive half the normal RIN crediting amount. That seems a little complicated on its face, but what it basically means is if you're going to import used cooking oil in your biofuel producer, you can still do that, but you're only going to get half the normal credit that you would normally get. So it's a very strong signal, an incentive to use domestic feedstocks first. So instead of soybean oil kind of being the residual, you're going to go buy a domestic soybean oil first. There's a lot of other things in the RVO. One of them is it would drop the RINs per gallon from renewable diesel from 1.7 to 1.6. EPA made a mistake with that 1.7, and again, this seems a little bit in the weeds, but let's say the RIN is $1 per gallon. It's actually higher than that right now. That change is a 10 cents per gallon change, which is a fairly big change overall. The biodiesel folks really like this because it helps level the playing field with them a little bit more on the renewable diesel side. And then, we have to talk briefly about small refinery exemptions because this has been a major issue in all of this. So in the original RFS, there was a provision for small refineries to help them transition to these new requirements. So if they produce less than 75,000 barrels a day as a refiner, they could be exempted for economic hardships. They didn't actually have to comply with the RFS. They didn't have to blend the biofuels. And so a lot of those refiners really like this one after this because it meant that they didn't have to buy RINs or buy biofuels. Um, the first Trump administration really handed these out like candy. And so they've handed out 1.7 billion RINs worth that year. And we saw RIN prices crash just because there were so many exemptions being given out because essentially an SRE is an exemption from the RFS, and so it lowers the overall blending mandate. So those numbers I was showing would actually be reduced in practice by the amount of these exemptions that were handed out. And these small refiners had not stopped petitioning since 2017, even though none have been granted. A lot of these petitions were just being held by EPA, and last time I checked, they were up to 189 petitions. And so EPA's had to make a decision on that about what they're going to do, and the implications are potentially huge because it could significantly cut the demand. So EPA and the RVO said, there's up to 18 billion gallons of fuel that could be exempted over the next 2 years. They plan to reallocate all of those gallons. So if they give out a small refinery exemption, they're going to raise the overall blending percentage for everyone else to hold the biofuel demand flat. Now, for the backlog for those 189 petitions, they've they've done a it's a fairly complicated system. Basically, if you have a very old petition, it doesn't matter. You may get granted, but it's so old. If you get a RIN back, it's past its 2-year expiration. But they estimate there's about 2.1 billion RINs that if they that could be still into play here that could be used in 2026 and 2027. EPA has asked for comments on 100% reallocation, so essentially hold biofuels harmless, or 50% reallocation, which would kind of split the difference. And so, we're still kind of waiting on this. We're not quite clear where EPA will end up, but this will also have very big impact. One other thing I'll point out is you've probably heard a lot about E15. There's been a very big push. Wrapped up in that E15 bill has been small refinery exemptions. Actually, that's been a lot of the holdup. Um, Currently, that bill would limit the number of small refinery exemptions in the future, but none of them could be reallocated. So it would be a straight reduction in biofuel use instead. And so for the final rule, EPA wanted to have it out by October 2025. That has not happened. I actually had a meeting with Office of Management and Budget this morning in the White House, who is finalizing the rule now, so it should be out soon. I'm going to skip the next point. Um, but there's a lot at stake here on how the half rent is done, because that could actually add a lot of volatility into the actual gallons needed because they would set the RINs that are needed, but you have different RIN generation based off of your importing or domestic. But this rules gonna be a very big deal. Whenever the headlines start coming out with the announcement, expect to see a lot of market movement in soybean oil and soybeans. Okay, so we're going to shift gears to the next thing in the credit stack, the clean fuel production credit, the 45Z. Um, so this replaced the biodiesel tax credit in the Inflation Reduction Act. It started in 2025, but we didn't even see guidance on it till January 10th. We still don't have full guidance on it. It was originally supposed to end in 2027. The One Big Beautiful Bill Act extended it through 2029. Whereas the blender's tax credit was a flat dollar per gallon, the 45Z is actually determined by carbon intensity. So if you think about the Inflation Reduction Act, a lot of that was kind of a climate change bill, right? And so they wanted to tie a lot of things to carbon and carbon intensity and greenhouse gas emissions. And so that's why we saw this change being made. And so basically, the simplified formula I'm giving here is you start at a dollar per gallon in the 45Z, but for every point in your carbon intensity score, you lose 2 cents. Up and you can only go down to zero, right? No credit. You don't owe anything. SAF originally had a higher credit amount, um, but that changed in the One Big Beautiful Bill Act. The one exception to the dollar per gallon max is if you're producing LNG or RNG, renewable natural gas from animal waste, such as hog manure. If you have a methane digester, there is no cap on that. And so, you talk to some of those guys, and they're potentially eligible for up to $9 per gallon in crediting from that. Um, and some of this, and that amount is conditional on meeting certain requirements, such as prevailing wage and apprenticeship. If you don't meet that, you get a lower credited amount. So, so that so it was established in the Inflation Reduction Act. When Republicans took control, they wanted to kill the 45Z credit because it was a carbon intensity credit. And then we saw the Midwestern lawmakers really stand up and say, we're not going to vote for any bill that gets rid of this credit. So they didn't, but they made some changes that were extremely beneficial. One is only North American feedstocks are now eligible for the credit. So it is a producer's credit, not a blender's credit. So the biofuel has to be produced in North America, and the feedstock has to be from North America. So you can't import tallow from Brazil and get this credit. The other huge change was indirect land use change was removed from the calculation of the carbon intensity score. So indirect land use change, or ILUC, is it's an economic concept that if we create more soybean demand here because of biofuels, that raises the price of soybeans, which encourages land in Brazil to come into production, which has very negative consequences for the environment down there. Um, we could talk probably this whole session on ILUC. I have a person that works for me that this is all he works on. ILUC is a lot of politics masquerading as science because it is unobservable, and so everyone kind of uses it to try to either penalize crop-based feedstocks or essentially penalize crop-based feedstocks if you don't like them. And so whenever the OBO was passed, it removed indirect land use change from the calculation. So you can see the original credits there in the IRA. Soy biodiesel is about 30 cents a gallon. Removing ILUC doubled it to 60. Soy renewable diesel about 10 cents a gallon. One Big Beautiful Bill Act took up to 40 cents. Canola went from 0 to 20 cents, and then corn ethanol wasn't is eligible for the Inflation Reduction Act, but generally didn't have the carbon intensity score to get a credit, and they go up to 10 cents a gallon now. Now this is plant specific. So I'm kind of using average numbers here, so any individual plant could be different. And then the last part of the credit stack that I'll talk about briefly before opening it up to Q&A is California's low carbon fuel standard. This program is in a lot of ways responsible for the rise of renewable diesel. So California Air Resources Board, CARB, oversees this program. It was started in 2009. And basically the way this works is there's emission reductions that are required for their transportation fuel. Um, and so the transportation sector, the fuel suppliers are responsible for this. And there's different ways you can reduce that your carbon intensity, and largely through biofuels. There's some other things, and so it's kind of like the RINs. They're tradable. So if you reduce your carbon intensity score more than needed, you can sell your credits, or vice versa. Um, and so it's kind of a not really cap and trade. It's kind of the opposite. Oh, sorry, I said that backwards. It is a cap and trade program. And renewable diesel took off in this largely because uh, ethanol is kind of capped with the blender or with the blend wall 10%. But in biodiesel, we talked about is typically not blended more than 20%. But renewable diesel is a drop in fuel, and so nearly all the renewable diesel produced in the country goes to California for this program. And I forget what the blending percentage is, but there's something like, I think like 70% of their diesel fuel is renewable diesel at this point. So it's mostly renewable diesel they're using out there. So this one state program has been tremendously impactful on the national biofuel policy. And so those credits I was talking about in their program have a price, and they were capped at about $200 a ton for a while, and they were at that cap. But renewable diesel was so successful, and so much was being sent there that it crashed the credit prices. Now, California doesn't like that. They really want to get to electric vehicles, and they want this program to help subsidize that. And you don't get there with cheap credit prices. And so they made some changes. But the other thing I'll point out is I kept on talking about used cooking oil and tallow getting really good credit values, and that's why renewable diesel producers wanted to use them. It's because of the California program. It wasn't the RFS. Before 45Z, it wasn't the blender's tax credit. 45Z briefly encouraged UCO, tallow, corn oil use, but that's largely been changed now with OBA. So it's really this California program that's really discouraged soybean oil use, and that's because of a high indirect land use change value. For soybeans, that's about half of our carbon intensity score in California. And the data they're working with is decades old and trying to measure that, and they will not update it. They just do not want to open that door. Um, so not only that, California was getting a lot of pressure from the environmental justice groups that also didn't like crop-based feedstocks. So in 2025, they put on a whole new slew of restrictions. So they put a cap of 20% of your biomass-based diesel can only be produced from soy, canola, or sunflower seed oil starting 2028. That's by company. They added traceability for ag feedstocks starting this year. No, they've essentially delayed that a year because they realize they have no way to actually monitor that currently. They have the ability to reject new biomass-based diesel plants in their program starting 2031. They've updated their carbon intensity goals. They said they were going to update ILEC modeling, but they just had a workshop that was mostly against ag feedstocks, and they don't really seem to be actually updating the models themselves. And so I'm almost done. I know I'm running up on my time here. But historically, the blue bars were the carbon intensity benchmarks that had to be met. The update that was just done for the new benchmarks were the orange. And kind of the average soy renewable diesel score is in gray there. And you can see in a few years, we're going to go from generating credits by being above that line to generating deficits being below that line. So it doesn't mean you may not use renewable diesel. It just means it's not going to make money. You're going to have to pay money to use it in the state. It still may be the best alternative to meet those CI scores, but it's going to really change the economics and how much fuel we consume in the state. And so I'm just going to wrap up with this. The reason we saw all those imports of used cooking oil and tallow was just the better crediting. And so you can see what the credit stacks here. So putting all those programs together in early 2025, and we had 45Z before the changes. And you can see corn oil, domestic renewable diesel did very well, as did domestic used cooking oil and tallow. Imported renewable diesel from imported UCO did well. At that time, you couldn't get the 45Z on imported UCO, but you could anything else. But you can see down on that list there was domestic soy, right? We're behind everyone else, and that's why we were the residual. Now, if we take all these changes into effect, some of them we know already, others are still in their proposal phase, but if we put all those together, we move up quite a bit. So yeah, domestic corn oil, domestic UCO, still kind of the most profitable on that credit stack. But those are fixed in supply. Those are harder to commit fraud on. But you see soy moving ahead of those imported feedstocks, which is really kind of the place we've been working to get to. So, kind of just the key takeaways, and I'll open it up for Q&A with Brad. Renewable diesel has provided rapid expansion for soybean oil demand. We saw that kind of get messed up by EPA not accounting for the increase in capacity, the feedstock imports, and then also California's programs that undercut that growth and really kind of crashed the markets for a while. But we are seeing federal policy changing in a very favorable way with 45Z, with RVO proposals. And we will be getting a lot more market certainty soon. We should be finalizing 45Z final rules soon and the RVOs, which should provide some certainty. I can almost guarantee they will move markets. I don't, I don't know exactly which way yet. We won't know that until the information is released. So with that, I'm going to stop sharing my slides and happy to answer any questions you all would have.
Scott, thank you very much and appreciate greatly the information. We do have some questions, some that I want to start with on a sort of a general outlook from here. Are there future growth opportunities? And if so, what's really going to drive them? That's as broad a question as you can get, but a little
Yeah.
more detail here specifically. Does EPA, in setting the renewable volume obligations, does EPA fundamentally set the size of the market, or
Yeah.
is the size of the processing industry sort of setting the capacity, which then EPA is responding to?
Yes. Yes is the answer.
Yes to both, maybe, right?
Yeah, no, it's a chicken and egg problem, and we've struggled with this. This since I've been at ASA, this is really the second time around on these blend levels that I've been involved in a big way. Um, and so I mentioned there's 7 billion gallons of capacity for biofuels. Um, it's actually hard to have the feedstocks to utilize all that. We tend to underutilize our domestic capacity for that reason. And so EPA is very explicit whenever they set those blend levels, which determine the overall consumption. They say we know there's the capacity out there, the production capacity, but we don't know if there's the feedstocks. So we're going to look at the feedstock availability to set those blend levels. And if, it kind of led to these circles a fairly infamous mistake by EPA in the 2023 proposal. So EPA, when they're trying to set soybean oil availability, looked at USDA's baseline numbers for soybean oil. Well, USDA's baseline levels for soybean oil assume constant policy, which means there's
Mhm.
no new production of soybean oil. So EPA was setting the blend levels based off of the assumption of USDA that EPA didn't change the blend levels. And so you kind of got, you know, got what you would expect out of that. So we were pretty quick to point that out that that was a problem and that we were in fact increasing capacity. And so you can go look at EPA's about I think 500 pages of rulemaking, and they'll cite ASA in there on looking at crush capacity. What was hard for EPA this time, and where I do have a little sympathy, or 2023, was we didn't have a lot of feedstock imports at that point. Um, no one saw it coming to the full amount or beforehand. And that's really what killed things because all of a sudden we could use a lot more of that capacity that EPA
Mhm.
hadn't accounted for. Um, I think it's a lot harder than it used to be to set it just because of that. It's, how much availability really is there out there and what do you want to do about that? But yeah, at the end of the day, we're fully dependent on EPA, at least at this point, to set those blending levels. Maybe at some point that there'll be enough large state programs that in aggregate they supersede the RVOs, but we're not at that point.
So if the blend level, the EPA regulatory process effectively sets the size of the market, then the RINs that are generated with that production help to pass returns back to the processing sector, which ultimately reaches back to the producer. Is that
Yes.
where the is that where the impact on the producer really comes from then, is the economic benefits of and competitiveness for sort of having a guaranteed demand there?
Yeah, largely that's it. So we now use more than half of our domestic soybean oil for biofuels. Um, so the other use is largely food use, and that's been stagnant for years. There were some changes in soybean oil labeling in food in the mid 2000s, I believe, like some trans fats and then partially hydrogenated oils. And after that, we kind of just almost saw like I believe a decrease per capita in consumption. And so in aggregate, we've just been being flat. And I've talked to some of our older board members. I say older; they're retired off of our board that were around in that era, and they talked about crush facilities that were trying to get permits to burn off the soybean oil at the time,
Mhm.
just because there wasn't a lot of value in it. And so it was really at that point almost seen as a byproduct. I mean, it wasn't worthless, but there just wasn't very much demand for it. It was really cheap. So biodiesel really helped fill that and grow it. And now we've seen renewable diesel take off. Um, but yeah, so that's kind of a long way of saying yes. It's largely through supporting soybean oil price because when you crush a bean, you're going to get 80% meal, 20% oil. You can vary that a little bit, but not a lot. So you have to have something to do with both products. And
Mhm.
historically, we've been crushing for the meal. That has changed. I mean, closer to half the value now is coming from oil side. So it really is more in balance. The one other way there could be more value to producers beyond just that is one thing I did not talk about, but the 45Z. Um, that potentially has provisions for farmers to reduce their on-farm carbon intensity score and increase the 45Z tax credit. So there's been a lot of excitement that there could be farmers getting paid through that tax credit. We don't have final rules on that. USDA has finished the calculator. Treasury has not wanted to include it. It's been a little bit of an internal political fight in the administration. Um, there's also some things we don't know, right? So 45Z tax credit is for the biofuel producer, right? So if a farmer increase or decreases their carbon intensity score on that feedstock, the biofuel producer still gets the credit. So how does that get back to the farmer? And so there's been a lot of discussions about, well, how do you what you use for record keeping is probably going to determine a lot of that. One of the things is mass balance, where everyone in the supply chain kind of does like an averaging, right? I know this is my average carbon intensity. I know I have this many beans with this carbon intensity, this one with this many. Doesn't matter physically what I sell to whom. It's just record keeping all the way through the system.
Mhm.
That would probably get some of the value back. What we've been pushing for is book and claim. So a farmer just sells their corn or soybeans like normal. They essentially have paper credits based off their carbon intensity, and they can sell that directly to the biofuel plant. So kind of cut everything out in between. Um, there's potentially a lot of value, especially on the corn side. When I've run the numbers for soy, if 100% of that value went to the farmer and soy, I think it's like $15 an acre. On the corn side, you're looking at $100 or more per acre,
Hmm.
just because higher yields, and a lot more gallons, of biofuels coming from
Yep.
that.
Yep. Yeah, it's a little bit of an allusion here to, we'll talk about ethanol next week with another Scott Irwin from the University of Illinois. And that, yeah, that does become a more of a question. I think I misspoke a bit when I say, is the real value coming back to the soybean, is it out of the RIN market or is it out of the 45Z credit? But you're
Oh yeah,
it's the 45Z
it's
credit.
it's both. So when I think about the credit stack, I think that about, well, what's your marginal feedstock? And that credit stack has to equal the difference between producing that biofuel and petroleum, right?
Mhm.
And so those credits in that credit stack can vary. California has its own market, so that price can go up and down. 45Z is largely fixed by facility. And so the RIN has to cover whatever remains. So I always think of the RIN as the residual because we know nationally we have to blend that much. And so that RIN is going to adjust. It's going to, you'll take everything else off first. You'll take that California credit. You'll take the 45Z. And then whatever cost is left over you need to cover is the RIN. So I always think of those three working in harmony. And, I don't really think that whenever we talk about biofuels and what's going on, we can really talk about any one of those in isolation.
Right, right. Okay, now a question about maybe some competing oils. You mentioned a bit about canola, although maybe a small relative
Mhm.
size of market. Corn oil is a competing oil that is increasingly a product and not just a byproduct in the corn ethanol processing sector. Um, what about other seed oils? Uh, a mention here, a question of cottonseed oil as well. Or what are other seed oils in an opportunity to claim some of this space as well, or is this predominantly soybeans market?
Predominantly soy, but also canola. We haven't, and I couldn't even tell you why not cottonseed. I'm not sure why on that or sunflower seed, but we really haven't. Um, there has been a lot of interest in producing new oil seeds just for biofuels, and those are primarily winter oil seeds. And I mean, some of that is also canola. We've seen some of the large companies get more involved in the winter canola for that, but also new products like camelina, carinata, things like that, that are intended to be put into a rotation over the winter and then harvested, for the seed in the spring to go to biofuels.
Hmm.
Um, there's some acres. I would call these more new crops, probably a little bit more in the experimental stage. There's some issues with those. I'm gonna get camelina and carinata mixed up. But one of them actually comes from a weed seed that's very small, and so you have to have the front end facilities at a crush plant to be able to run it through because it's so small that if you go and have a soy only plant, you try to put it in there, you're gonna have a mess. There's questions. And then what do you do about the meal? Is the meal approved for these uses? So I mean, these things are getting worked out. But I mean, there are the big players behind these, like the Bayers, the Cortevas, the Bunge. So I mean, it's not just a niche. We are seeing the big guys make investments in the space.
Scott, another question from one of our great listeners. Uh, if you showed that map, don't go back right now, but remember that map that you showed about where the soy processing plant expansion had occurred, and a couple of those plants were in Nebraska that have
Mhm.
grown our capacity in the state. But we also had more ideas and maybe more proposals for plants in the state. And part of that based on the idea that this renewable diesel market was going to continue to grow. Still dreams about sustainable aviation fuel or maybe even sustainable maritime fuel. Uh,
Mhm.
what, but the question being, as you sort of described, the market seems to fundamentally be policy driven.
Mhm.
So the question, if I summarize, is can we ever get to a point of having enough policy certainty to be able to make sound investment decisions here on capacity in the industry?
That's a really, really good question, Brad. Um, Frankly, what we saw was that this past time around were investments through exuberance that overran the policy and crashed the market, right? I'm not.
Mm.
I don't think anyone's wanting to do that again right now. So I think we're gonna
Money's not as cheap as it was
right.
4 years ago, too.
That's been critical. Higher interest rates, steel and aluminum. I mean, we have steel and aluminum tariffs. Steel and aluminum costs have gone up, which is a significant cost in those plants. So costs have really gone up, and crush margins have come down. I mean, I showed they're not
Yeah.
bad, but
Yep.
you're not making money just without even opening your eyes anymore if you run a crush plant. It takes a little bit more, um, and we've also seen some of those. Look bigger companies pull back on maybe some of their planned investments, instead do some buyouts of some smaller companies. Um, so yeah, I think everyone is mature. There's just a little bit more maturity in this right now. We saw a lot of new entrants. We just saw a lot of exuberance.
Hmm.
Um, EPA is trying to do longer time frame RVOs to give more certainty. That's what the industry wanted for a long time, and we only got annual. Um, the 3-year one that they just did turned out to be like more of a blessing or sorry, more of a hindrance than a help, because they underset it.
Yep.
Now if EPA really does finalize this proposal, it's really good. That provides certainty through the 2027. And I don't think it's quite accidental. That gives this administration one more shot at an RVO before they term out. Right. And so I think we could very likely see a 3-year rule or more coming out
Mhm.
at that point. So I think there's an understanding that there needs to be some certainty here. Um, and so I think we have some shot at it. And so I think we could see some more crush plants come online if we can get those longer term positive signals. But I don't think we're going to see a lot of
Yeah.
new announcements until we get those signals.
Yeah. Thank you, Scott, for that. As we close today, actually, Scott, I'll offer you one chance. You've provided some great information, but I'll give you the final word if you have something you want to add that we haven't touched yet.
Yeah. Yeah. So this has been a really great space for growth in the industry. Yeah, coming whenever I did to ASA, I unintentionally timed it quite right to ride the markets up pretty well because of this. Um, with everything going on with trade war with China, I think this has become even more important. There's a lot more focus on domestic consumption. We see more support from the administration for things that would give domestic consumption. But I also don't want to give the illusion that this covers any sort of export problem. To put it in perspective, for the new plants coming online this marketing year, that'll add a little less than 3 million metric tons of capacity. We're probably going to lose 10 to 12 million metric tons of exports to China this year. I don't
Mhm.
know what next year is going to look like. So these things help. They provide support, but I also don't want to give the illusion that it's just a silver bullet that can fix any other issues that might be
Yeah.
occurring.
So the added domestic processing, the added domestic demand doesn't completely replace the need for continued focus on global markets.
Exactly.
Understood. Thank you, Scott.
Mhm.
Well, thank you very much for joining us and providing your expertise. I look forward to another time that we can do it again and maybe someday talk about sustainable aviation fuel and maritime fuel if those markets do pan out or if they
That
ever
would be
take
great.
off, so to speak, to use
Yeah.
here, right? But in the meantime, thanks to the rest of you for joining us as well. Thanks for joining another webinar from our Center for Ag Profitability. You can find a recording of this webinar. It will be posted later today. You can also find, as always, a variety of farm and ranch management information, tools, resources, and other items on our website at cap.unl.edu. As you exit the Zoom meeting today, you're going to find the usual short survey. We'd love to have your opinion about today's discussion and content, and we'd love to have your ideas about future topics we might cover in this webinar series. We value your feedback. It certainly helps us be able to understand our impact and our efforts, and it helps us to know where to go. So we value your feedback. We appreciate you taking a moment to complete that. Finally, thanks again, Scott, for joining us today. Thanks for the presentation. Thanks for providing the expertise that you can from your role at the American Soybean Association. With that, I appreciate it, and I can bid everybody a good afternoon.
Right.